morning, everybody, and welcome to the Courtiers 2021 Client Seminar at the London Marriott in Grosvenor Square. We've got an absolutely packed session for you this morning. I'm your host, Leo Hallam, the Head of Brand and Communication. All I know is shapes and colours, but this team blows my mind. They're going to be talking about investments, for the most part, your investments, and what's happening in the global financial markets. So to begin, we'll have James Timpson I'll introduce to the stage. He'll be talking about global markets and Courtiers fund performance throughout 2021. After this, we'll have Jacob Reynolds, our Head of Asset Management, talking about Courtiers stock selections in some detail. After this, environmental, social and governance will be covered by our product specialist Katie Crook, after which Gary Reynolds will take us through rising inflation and interest rates and whether this is a 70s repeat. Throughout the seminar, you will have question cards on your tables, so please write down any questions that you might have, and we'll collect these during a short break before a Q&A panel where we'll talk to all of the speakers. So let's go. Competition time. We've got what I think might be the world's most difficult quiz on Friday, December the 10th, 2021. And if you see your question cards in front of you, fill these in and we'll collect them before the Q&A. And we'll select a winner at random. And we'll take a lot of time to work out who got the questions right and who didn't. Not really. So the first question, when did Disney release its first feature film? Was it 1937, 2007, or 2017? Question 2, what was the title? Was it Snow White and the Seven Dwarfs, Frozen, or Lock, Stock and Two Smoking Barrels? And finally, which of these was not one of the seven dwarfs? Happy, Grumpy, or Bitcoin Investor? Good luck in the quiz. Okay, what I'd like to do now is introduce our first speaker, James Timpson, Deputy Fund Manager. I've been working with James for about 5 years now. We represent Courtiers a lot at the Rams Rugby while they're playing. We're a major sponsor there. And if he's as good at analysing markets as he is the games, then you're all in good hands. James, welcome.
Thanks very much, Leo. Good morning, everyone. Well, what a year it's been. William Shatner went into space. England nearly won the Euros, and we finally got to see the new James Bond film, which featured the threat of a contagious virus spreading around the world. Seems a bit far-fetched to me, but it's still a great film nonetheless. It's also been a really interesting year for global markets, so I'm going to count down 5 of the biggest talking points surrounding markets this year. We begin at number 5 with meme stocks, also known as viral stocks. So what exactly is a meme stock? Well, these are companies which have typically been struggling financially, but then see a big surge in popularity, normally online or on social media, which results in their share price absolutely skyrocketing, normally far beyond the company's fair value based on fundamentals. And their rise in popularity this year has been attributed to the pandemic, with retail investors looking for ways to amuse themselves and also make a quick buck whilst in lockdown. And the biggest meme stock of the year is GameStop. Now, GameStop is the world's largest video game retailer. It has over 3,000 physical stores in the US and a further 1,500 around the rest of the world. In the last few years, it's been struggling with its revenue, with physical sales being shunned in favour of downloadable games and content. This is the company's share price from 2016 through to last summer, and in that time, it's lost over 80%. And with the company's prospects looking so bleak, the shares have been shorted by numerous hedge funds who expect the price to fall further. Now, all of this short selling was picked up by a community on Reddit, an online discussion forum. They saw an opportunity for a short squeeze. This is where a company's share price is pushed up to the point that all of the short sellers are forced to cut their losses and exit the position, and this just pushes the price up even higher. So if we extend this chart to the end of last year, you can see that price gradually beginning to rise. But then in January this year, the Reddit group gained massive traction, and suddenly this happened. In 1 month, GameStop shares rose 1,625% as retail investors piled into the stock. And all of those hedge funds which had been shorting it lost an absolute fortune. The shares became so volatile that some retail apps even banned the selling and trading of GameStop shares. But interest in the stock remains high to this day. It's still incredibly overvalued, especially when you consider that its most recent earnings were negative. And all of this shows that short selling anything is an incredibly risky practice because your potential losses are unlimited. And this is why we've never short sold any individual securities in the Courtiers funds. So on to number 4 then, and this is inflation. This has been a huge topic this year, with levels of inflation reaching their highest for a number of years. Here in the UK, inflation is measured by the Consumer Prices Index. And in October this year, the index rose to 4.2%. So the average price of goods and services in the UK is currently 4.2% higher than it was this time last year. It's the highest it's been since 2011. And it's also well above that 2% target rate set by the Bank of England. Over in the US, inflation's even higher. The most recent figure is 6.2%. This is the highest it has been since 1990. So in other words, the last time US inflation was this high, the World Wide Web didn't even exist yet. And neither did I, for that matter. Now, the basket of goods, which the ONS uses to calculate the Consumer Prices Index, has around 700 representative goods and items in it, which are designed to reflect the latest consumer trends. And this basket gets updated each year in February to ensure that it's still reflecting the latest trends. So as a fun game, I'm going to put some items on the screen. Can you guess whether these items were added to the basket this year to reflect the latest trends, or were they removed? So are they in or out? And we start with hand sanitizer. No prizes for this one, in or out? This is in, simply reflecting a huge increase in expenditure over during the pandemic. Next, we have ground coffee. Is that in or out? This is out. So this has been replaced by coffee sachets, reflecting a trend towards all-in-one beverages. Next, we have Maltesers, or malted chocolate sweets, as the ONS puts it. Are they in or out? These are in. So these are replacing a less popular white chocolate item. Next, we have the 9-carat gold chain. Is that in or out? This one's out. So the ONS has discovered that the price of the gold chain simply mirrors that of the gold ring. And they've decided they only need one of them in there, so they've kept the ring and ousted the chain. And finally, dumbbells. Are they in or out? These are in, reflecting an increase in expenditure during lockdown and a general trend towards healthier living. Now, I won't talk too much more about inflation because Gary is going to be covering it later on, but it does tie in very closely with number 3 on the list, and that is supply shortages. So these have been causing havoc with markets this year, with all sorts of goods seeing large rises in demand. Among these are electrical components, things like semiconductors and microchips. But because of factories and ports being closed, there's been a shortage of these, which has slowed down manufacturing and led to a shortage of electrical goods, such as mobile phones, home appliances, and cars. According to the SMMT, this September saw the lowest number of new cars registered in the UK since 1998. It's not just electrical goods, but also energy supplies. With demand for fuel rising, fuel prices have also risen. So this is the crude oil price, and after falling below $20 per barrel during the height of the pandemic, it's gone on to surpass $80 per barrel and reach its highest level since 2014. There's been an even bigger spike in natural gas prices, driven by both demand and also a curb in supply from Russia to Europe. In October, the natural gas price rose to its highest since 2008. And here in the UK, we've been particularly badly affected due to limited gas storage facilities. Domestic consumers have been protected from this by the consumer price cap, but businesses and energy providers have been hit hard. So hard, in fact, that many of the smaller energy providers have either gone bust or been forced into administration. This is just a selection of them, But so far there are about 28 and counting, with all of their customers being transferred to one of the larger providers, such as British Gas or E.ON. But now we go from the supply to the ridiculous, because at number 2, it's cryptomania. It's been a huge year for cryptocurrencies, with the largest of all, Bitcoin, reaching massive new highs in 2021. According to a YouGov survey, the number of UK investors with exposure to cryptocurrency has risen from 3% 2 years ago to 8% this year. So why have cryptocurrencies become so popular? Well, several large companies have said that they're going to accept Bitcoin as a valid means of payment. Companies like Microsoft and Starbucks. Earlier this year, PayPal announced that it would be allowing its 400 million users to buy, sell, and trade cryptocurrencies. And I've even seen some articles describe Bitcoin as the latest safe haven asset. But the truth is, there are still significant issues here. For a start, there's nothing sitting behind Bitcoin. There are no real assets sat behind it. There are no regulatory bodies or governments supporting it. So really, its entire value is derived from people saying it has value. It's also incredibly volatile. Here's the volatility of some major asset classes, where volatility is just a measure of the day-to-day variation in price. So at the bottom there, you've got cash, which has virtually no volatility. And you go up to gilts, gold. FTSE 100 is fairly volatile. Chinese equities, even more so. And then Apple, an individual stock, that's riskier still. So where does Bitcoin sit? It sits there. It's almost 5 times more volatile than the FTSE 100 index. And this is the asset being described as a safe haven. Not sure I see it myself. But Bitcoin, of course, isn't the only cryptocurrency. According to Statista, there are over 7,000 cryptocurrencies worldwide, all hoping to catch on. And this gave me an idea for another game. I'm going to put some potential cryptocurrencies on the screen. Can you tell me whether these are genuinely real cryptocurrencies, or have I made them up? Are they real or fake? And don't forget to play along at home. So first up we have sushi. Is that real or fake? This is real. So this was founded in 2020 by a mysterious entity known only as Chef Nomi. How about eCoin? Is that real or fake? This one is fake. So this is actually the fictional cryptocurrency used in the acclaimed TV series Mr. Robot. How about Epic Cash? Is that real or fake? This one is real, although it's currently the 809th largest cryptocurrency in the world, which doesn't seem particularly epic, does it? How about Tiger King then? Is that real or fake? This one is also real. So this one is genuinely inspired by the Netflix series of the same name, and was even endorsed by Joe Exotic himself. Castle Coin, is that real or fake? This one is fake. So this is, of course, the currency used in I'm a Celebrity, Get Me Out of Here. How about Panda's Figs? Is that real or fake? This one is fake. There is no cryptocurrency called Panda's Figs. It's just simply an anagram of passing fad. And last but not least, Titcoin. Is that real or fake? This one is 100% real. So it was developed in 2014 for the adult entertainment industry as a means of performing anonymous transactions. It's since been acquired a number of times, and there's plenty more information online if you want to keep abreast of it. So let's move on to number 1, shall we? This is simply the road to recovery. So last year, a well-known virus caused markets to crash. Equity markets lost 30% in just 1 month. But since then, they've been recovering fairly rapidly. And that rally has continued into this year. So markets have been rallying despite all of the inflation fears, the global supply chain issues, and of course the ongoing pandemic itself. Markets have still been volatile. It's just that volatility has been nowhere near as severe as it was last year. You may remember this chart from last year's seminar. It shows the number of times each year that the global equity market has moved more than 2% in one day. Last year, that happened 40 times due to all of the volatility caused by the pandemic. This year, it's only happened 3 times. So it's actually been a really positive year for equity markets. And that leads me very nicely onto fund performance. So how have your Courtiers portfolios done this year? So let's start with the cautious risk fund on the left. This can only invest a maximum of 60% in equities. And it's returned 10.7% this year. That's more than 2% ahead of its IA peer group. That's a collection of funds with similar risk mandates. It's what you'll see us judged against on things like the fact sheets. The balanced risk fund, which can take a bit more risk, has returned 14.8%. And the growth fund, which is the riskiest of the three, has returned 19.1%. So we're really pleased with how all three of the Courtiers multi-asset funds have performed this year. It's also been a great year for the equity funds. So the UK Equity Income Fund, which invests solely in UK stocks, has returned 29.6% this year, and the Global Equity Fund, which invests in global stocks outside the UK, has returned 21.2%. And finally, the Investment Grade Bond Fund has held up really well in what's been a topsy-turvy year for fixed income markets. So we're actually delighted with the returns from all 6 of the Courtiers funds this year. Now, if you've been to one of these before, you'll know I like to finish. As a big fan of game shows, I like to finish with a game of play your markets right. I'm going to put some market returns from the year up on the screen. Can you tell me whether the next one is higher or lower than the previous one? So UK equities have returned 16.8% this year. Is the US equity market higher or lower than that? It's higher. It's been another big year for US with those big tech companies thriving during the pandemic. How about European equities? Oh, spoiler. It was indeed lower, 18.6% for European stocks, but still a strong year for them. So how about Japan, higher or lower than Europe? It's lower. So Japanese stocks have returned 12.2% this year. How about gilts or government bonds, higher or lower than 12.2%? Yeah, these are lower. It's actually been a negative year overall for gilts, with interest rates slowly recovering from their all-time lows. So how about gold, the traditional inflation hedge, higher or lower than -1? It's actually very close, but it is just a little higher. So despite all the inflation fears, it has been a fairly underwhelming year for gold. So how about copper then, higher or lower than gold? It's not so close, this one, 25% for copper. Like many things, its price has surged as the economy has recovered. So copper's had a much better year than gold, although I still wouldn't recommend using it for your wedding ring. And finally, Chinese equities, higher or lower than 25. Not every market can be a winner, and Chinese equities are down 17% this year, largely due to all of the tight regulations being imposed by the government. So there we have it then. It's been another really interesting year for markets and a prosperous one overall. Thank you all so much for listening. I hope you all have a great Christmas. Thanks very much.
Thank you very much, James. I realised watching James's presentation that we've actually got a copy of the slides right in front here, whereas I was doing this to begin with, and that's because the lectern's too high and I'm too short. So I apologise to the cameramen if you get a little bit dizzy having to do this. Now I'd like to invite our next speaker, Jacob Reynolds, to the stage, who's going to be talking about stock selection. Jake, I've also worked with Jake for 5 years, by the way, but I realise that's because I've worked at Courtiers for 5 years. Jake's been there longer. Thanks, Jake.
Thanks, Leo. Good morning, everyone, and good morning to everyone joining us online. So, yes, today I'm going to be talking about our stock selection in action, where we've invested your money this year, what we've been selling, what we've been buying, and what we've held during the period. So, for the newcomers, we are value investors. It is said that price is what you pay and value is what you get. What we are trying to get is dividend-paying companies with stable earnings, strong cash flow, good balance sheets at a good price. Or, as Warren Buffett would put more whimsically, whether we're buying stocks or socks, I like to buy quality merchandise when it's marked down. So whilst our approach to value investing is unique in the blend of the metrics we use and the way we build up the portfolio, it's nothing new. It was first written about in principle in the 1930s in a book called Security Analysis by Benjamin Graham. But we don't take this approach because of a good quote, because of a good book. We take it because we try to build the best exposure to equities that will give you the best long-term returns. Now, luckily for us, two economists in the 1990s, a Nobel Prize winner called Eugene Fama and Kenneth French, did an experiment. And what they did was they went back and they got the whole market. They lined up all the stocks, they ranked them via earnings yield, and they built a portfolio of the top 30%, so the value stocks where you get the most bang for your buck, and they built a portfolio of the bottom 30%, the most expensive stocks in the market, and they went back to the end of 1974, and they tracked the performance of that portfolio going forward. Now, the black line is the market, all the stocks available, and the top portfolio, that value portfolio, had significant outperformance during that period. And if you'd bought that expensive stocks, James was talking about the S&P, those expensive tech stocks in the US, that sort of approach, that growth approach, would be a massive drag on capital over the long run. In fact, a value approach would have 3 times as much wealth as a growth approach on the orange line from the end of 1974. Now, this is a theoretical academic experiment, but now the UK fund, an isolated example of this approach, has been running for 6 years. And once again this year, it is the top fund in the peer group, and it is the top fund since inception when it was launched at the end of 2016, at the end of 2015, in November that year. But that's a UK fund, this is a UK chart. When Fama and French did this research, they called it the international evidence because they went all around the world to see how this performed. And when we look at it from a global perspective, we see the same trend. The black line is the market, the MSCI World. The blue line is a value approach, whilst the orange line is a drag on capital. Overpaying is one of the biggest risks you can take in the portfolio, so it's really important to find things at reasonable price. But what has been driving our performance this year? What companies have we invested that exhibit these characteristics that bring this approach to life? So last year we spoke about Reach. Reach was formerly known as Trinity Mirror. It is the publisher behind the Daily Express and the Daily Mirror, but more importantly, a huge portfolio of national and local newspapers. In 2020, in any one month, Reach would get 42 million unique visitors to its websites. It was the 5th most visited company online, only beaten by companies like Google and Facebook. When you start to get that many people visiting your site, you can start to build up advertising revenue. You can start to build up profiles on the users and track them across the internet and then sell that on to advertisers as well. This meant that they had growing advertising revenue. And when we spoke about Reach last year, we bought it at about 3 times earnings. Now, to put that number into perspective, to sort of bring it to life, the market normally trades at about 13 to 15 times earnings. So from an earnings perspective, when you were originally buying Reach, you're getting it about 1/5 of what the market would normally price in. By the time we spoke about it in December last year, to sort of highlight how incumbents can fight back and compete with tech firms, it was up to about 4.5 times earnings and it returned 86%. This year, it continued to chase down that discount. Think of Buffett's markdown stocks no longer being marked down. It went to a more market normal multiple. And at this point, because we screen all the fundamentals of the market constantly, it fails to exhibit the characteristics of a value stock, and that would mean that we sell out the position. So we sold it this year, and actually since falling, it's because it would become expensive, it's actually fallen 40%. Now, whilst value is the core of our approach, it's not the only thing we do. We look at quality, which is super important in an inflationary environment. That looks at a company's profitability, its leverage, and its dividend payouts. But we also look at ESG, which Katie is going to talk about later on. The G in ESG approach stands for governance, and this is something we take really seriously. Royal Mail is an example of a stock we sold for governance reasons. Now, in 2019, we bought the stock. And at the time, the CEO, Rico Back, was trying to transform Royal Mail from a letters company that delivered parcels to a parcels company that delivered letters to make it more future-proof. They took advantage of the lockdown when people were getting a lot more home deliveries, and that was very profitable for them. But in 2021, Rico Back resigned. At this point, we review the new management, we give them a chance, but we felt that the new CEO didn't have as much control over the unions as the previous CEO, and they were at risk of moving back to a more state-like, inflexible organisation, away from the dynamic private organisation they had become. We sold Royal Mail halfway through this year, and actually it's fallen 15%, initially down 25% from when we sold it. Now, that's two stocks we've sold. What has been replacing these stocks in the portfolio? So I want to talk about a stock we've bought this year. It's a very, very well-known high street name, but it started life in 1884 in Leeds as a penny bazaar, which is an oldie-worldy term for a pound shop. Does anyone know the name? What? M&S. Yes, very good. Sorry, there's not a bottle of crew for this one, but yeah, M&S. First listed on the London Stock Exchange in 1988. It was a darling of the market for the first 10 years, and in 1998 it would become the first UK retailer to make pre-tax profit of over £1 billion, and it ballooned to a valuation of over £18 billion. But in 1998, M&S would start to run into problems. Increased global competition meant that their domestically produced clothing was uncompetitive, and when they tried to head off that risk, they moved too late, they undermined their quality and they undermined their brand, and they started to lose customers. Over the next 2 years, M&S's share price would lose 2/3 of its value. Now, in 1998, £1 billion of pre-tax profit is about 800 million post-tax profit. An £18 billion valuation means that you're trading on a multiple of over 22 times. So if we go back to our market of between 13 and 15, the sort of stocks we look for, like Reach on 3 times, you've got M&S up here. One of the stocks in that orange line. It was very expensive, and when they've run into problems, then it's a very long way down, and it can drag down, and it can be a real drag on capital. But in 2017, M&S came up with a plan. They called it Never the Same Again, and they had to face a number of headwinds: the march of the discounters in Aldi and Lidl, further increased global competition, the death of the high street, the move to online, and the move to online, move to home deliveries, groceries. So in 2017, they came up with a strategy called Never the Same Again. They went and they got 50% stake in Ocado, a leading online grocery delivery company. They got exclusivity to supply through that platform, ousting Waitrose. And they started to reduce their clothing line, going back to what they were known for in the 90s. So between 2018 and 2020, they reduced their clothing line 30% to get back to the quality staples that we know M&S for. And they started to build more stores like this. These are small box out-of-town formats like Lidl and Aldi, and they run on a much higher margin to their high street stores. They require less staff to run, and the rents are cheaper. So they've been moving away from the high street formats to these, and I expect a lot of you have seen these cropping up near you. I know I have. And so M&S has been on our value screens for a while, but we bought it this year because we had to see evidence of the turnaround, and actually it's gone really well for the first few months. It's already up 50%. But when we talk about screening these fundamentals constantly, when we look at the characteristics of Reach, or we look at M&S and we see it climbing the value screen, we say, okay, what point are we gonna invest in this stock? This doesn't just benefit the equity funds or the direct equity portion of the multi-asset funds. It benefits the multi-asset funds as a whole. And I want to give an example of this. Now, interest rates are at 700-year lows. In 2020, going into the global pandemic, by nature of the last crisis being a banking crisis, banks got sold off very heavily. And we started to see them climb our value lists, and we started to look into this. And this was compounded by a regulatory change in 2018 that meant that banks had to account for their expected losses that didn't materialize. And so we thought these were very, very attractive investments, but not only that, we know that banks perform really well in rising interest rate environments. That's because they can start charging more on their loans. So we bought Wells Fargo for the multi-asset funds in May 2020, as we felt it was a very cheap and effective way to hedge interest rate risk, and that's actually up 98% since we bought it. But as Warren Buffett would say, every decade or so, the clouds form on the economic skies and rain gold. And when that happens, it's imperative that you go out with bathtubs and not teaspoons. So we bought PacWest as well for the multi-asset portfolios, and that's up 140% since we bought it. This has been the top stock of the directly invested multi-asset positions this year. Actually, 3 of the top 6 direct equities have been banks, and it's been really effective way of riding those interest rate rises that we've seen, but we still don't see a full normalization on interest rates yet. But we hold about 70 to 75 stocks on the portfolio. I can't talk about all of them, just talk about the ones that sort of highlight the process. So we've backed by popular demand is the Courtiers gift list. So you can give the gift of giving back to yourself by supporting the companies in the portfolio this year. So for the technophiles out there, how about a Samsung Galaxy Fold? This is part of the emerging market exposure in the multi-asset funds. We invest in this company as part of emerging markets because it's listed in South Korea. But not only would that support Samsung, the company that makes the screens is a company we invest in called Corning. They make Gorilla Glass. And at the end of 2017 alone, their screens were in 5 billion devices worldwide, so they're probably in your pockets right now. And not only that, this really highlights the complexity of modern global supply chains. We also hold Qualcomm, which makes the 5G chips that go in these as well. Now, I know Christmas was a subdued affair last year, so for those that have gone a bit overboard on the tree this year, how about an 11-meter high articulated boom? It's actually quite difficult to come up with this list because a little teaser for Gary's presentation later, so much of the developed world has moved to services. They don't actually produce as many goods anymore, and it's harder to wrap a service, but maybe it's even harder to wrap this. But this is made by a company called Linamar. They are part of our global exposure. They're a Canadian company, and this is a subsidiary that makes these. And lastly, for those that don't like Christmas pudding, the man himself, how about Colin the Caterpillar? Currently having an existential crisis and suing anyone that looks like him. But we've also bought Tesco this year, so if those of you that don't want to fork out £7 for Colin, there are some other options. There we go. So Curly is available as well. But we've done extensive research on our Caterpillar cakes, and I can assure you that Colin is superior. Thank you very much for listening. We'll be around for any questions later on. Feel free to come up and ask, as well as a Q&A later. Thank you. Merry Christmas.
Thanks very much, Jake. Now I'd like to introduce Katie Crook to the stage. Katie started life at Courtiers in the power planning team, and her focus on sustainability and fine attention to detail, as I'm sure you will see, moved her into the investment team to focus on ESG. Ladies and gentlemen, Katie Crook.
Oh, it's going to be a slight delay slide. So, although ESG was covered at the last seminar, it's an ongoing process. So we wanted to give you a bit of an update on what's changed in the last 12 months, how we've evolved our process, and how we've actually put that into our process. But just to recap, ESG isn't a fixed standard. It's actually a set of non-financial factors. So E looks at environmental factors, so that's pollution and waste management. S looks at more of your social factors, so human rights and animal welfare. And G looks at the governance factors, so how companies are run and their potential for corruption. It should be noted that ESG isn't the same as ethical investing. Ethical investing is actually a subset of ESG, which focuses on exclusionary screening. For those clients that do want exclusions, we do have the Courtiers ethical portfolios, but that's not the same process that we use in our own funds. So let's go back 12 months. 2020 saw the pandemic, lockdowns. Now we're in person, well, most of us. The pandemic actually saw an increase in social and corporate activism. We had the Black Friday Amazon protests on workers' rights, as well as the September climate strikes. The interesting thing about this social activism is it actually brought ESG factors to the forefront of both business and consumer minds. However, ESG isn't something new to Courtiers, nor the industry. We actually launched our first ethical portfolio all the way back in 2005. MSCI launched the first socially responsible index over 30 years ago in 1990. The term ESG was actually first noted at the UN Compact's 2005 conference on investing for long-term value. This noted issues with regards to how companies integrated ESG metrics into their reviews, as well as lack of availability in terms of ESG data. We've actually always incorporated governance factors into our analysis, primarily as we believe strong business and good governance go hand in hand. The only reason we didn't have a strong focus on social factors and environmental factors was due to lack of measurable data. However, that's now changed. If we move forward onto the end of this year, there was a 30% increase between 2019 and 2020 in sustainable mandated funds. At the end of October, Morningstar confirmed they had over 7,500 sustainable mandated funds. And this increase has actually been driven by demand. Businesses are now taking account of it, and they realise they have to change. At the end of this year, there'll be 36 providers on raw ESG data, which is huge compared to previous years. There'll be 28 focusing on climate risks and supply chains, and 7 just looking at biodiversity. So as you can imagine, this has kind of created a minefield for ourselves. So what did we do? We looked at the raw providers of ESG data, and we wanted to see which one would actually complement our process. We use quite a risk-based metrics, and some of them use performance-based reporting. So following an in-depth review, this came to us deciding upon Sustainalytics. They look at 17,500 companies. MSCI, who's a very close competitor of theirs, only look at 8,500 companies. And although the number rated by each is growing, we didn't want ESG to be a bolt-on. We wanted something that was fully incorporated into our process. The really good thing about Sustainalytics is they look at 90 management indicators. So they'll look how carbon intensive the company is, what they're doing to reduce waste, what their controversies are. And the main thing for us is to look at mitigating ESG risk. ESG risk, for example, is what a company is doing to mitigate controversies and how much more they could do. So, for example, if a company is involved in deceptive selling techniques, this can cause issues with their customers, lack of trust and reputational damage. We don't want those issues to come along later and cause problems for the companies, so we drill down into those. However, Sustainalytics gives us a number, and a number isn't everything. Our analysts will look at the bigger picture. They will take that output taken by Sustainalytics and they'll say, okay, what's the company already doing? What are they going to do in the future? And are they bringing anything new into their process? They'll incorporate this into their notes. And what was really interesting to see was, although we didn't have a specific focus on the social and environmental factors, actually, because we'd spent so much time focusing on the governance, is that the score for those other two were relatively low. Now, Sustainalytics will give you a globe rating for individual securities as well as the fund, and the maximum score you can achieve on your fund is 5 globes. All the multi-asset funds and the UK Equity Income Fund have achieved 4 globes, and that's without us formalising this process. So for us, that was validating that we were doing the right thing. Having said this, there are no exclusions from the funds. The reason being is we would rather see a company that's made mistakes in the past that actually want to go forward in a positive way. They want to make change. You know, they don't want to get stuck in their past mistakes. They want to bring about positivity in the world. However, having said this, we will monitor them. So if we came 12 months down the line and they're not acting on those promises, we would get the analysts to review that and go, okay, is this something that's going to stay in the fund? We've done that quite regularly. We do it on a monthly basis. We look at all the underlying holdings and the fund overall. And if there are changes to those scores, we do monitor those. So an example of a stock that we've got in the fund is Devro. At the beginning of the year, Devro actually had the worst ESG risk score in the fund. Not because they were doing anything bad. It was actually because they hadn't formalised their process. Devro's done a lot of work in the last few years, and since 2015, they've reduced their waste by 91%. They want to go further though. So by 2025, they want to have reduced this a further 30%. They're really high focus on active engagement. They're looking at new technologies. They want to reduce their water waste. All of this work together has actually reduced their ESG risk score by 18.5%. However, if we'd gone on just the numbers, these guys would have been excluded from the fund. A more recent example is Polymetal. Polymetal is a precious metals miner, and they're noted as having one of the best ESG risk scores in their sub-industry. They've got really good governance, really good management, and they actually have got really good business ethics. They engage with the local communities. And the good thing about Sustainalytics is it shows you if a company is an industry lead or they're lagging. And these guys are definitely a lead, so we were happy to include them in the fund. However, ESG isn't a static process. The legislation in regards to it is still evolving. How we incorporate it will change. The FCA have held their hands up and said, look, we need to put some more guidance in, greater investor education, because there are no standardised calculation measures or labels for how sustainability is incorporated into funds. As this goes forward, we want to adapt our process to align with this, but it's not something we can do straight away. But we are looking to be proactive and put more things in the fund and more data availability to you, so you can see that we're actually acting on this and it's not just something we're labelling and say we've done. So over the next 12 months, we want to build on the process we've got in place. We'll have all the stocks within the portfolio reviewed, and the good thing about that, and the fact that we do subsequent reviews if there are changes, is we can see if companies are actually acting on their promises and not giving us lip service. Hopefully by the time we're here next year, we'll be able to give you an update on what's changed and possibly what's been removed on the portfolio because they aren't changing in a positive way. Thank you.
Thank you, Katie. Well, now I'd like to introduce our final speaker of the day, and anybody please do write down any questions that you might have for the panel that's to follow, and viewers at home as well, please click the Ask Us a Question button, send us any questions you might have regarding the presentations or anything else. Now, introducing to the stage Gary Reynolds. I've actually worked with Gary over the last 20 years as I've been involved in some capacity in one way or another with the Courtiers brand and his much beloved rugby club, Rams Rugby. Gary, it's a pleasure to welcome you.
Thank you, Leo. Welcome everybody online. Thank you everybody for coming along to the Marriott Hotel today. It's a lovely place. It was so nice to be able to get out. I can recommend the Lucky Cat restaurant, which we ate in last night. So, the question that I've been asked to deal with today is inflation. Are we going back to the 1970s? Napoleon once said that to understand the man, you need to understand what the world was like when he was 20. When I was 20, it was the 1970s. We had rampant inflation, went over 20%. We had 3-day weeks. We had huge amounts of problems with government debt. And there's a lot of worry as to whether we're going back to that situation again now, with government debt rising and inflation going up. You saw James mention that in the UK it's gone over 4%, and in the US it's up to around 6%. And of course, there's a lot of concern about borrowing and interest rates following along. So it's a spoiler. It's not going back to the 1970s, no way. But there are some other issues that we need to address. Now, what I want to do is to look at long-term trends, because to understand what's going to happen in the future, the best way of doing it is looking back over the past. I'm going to take a quick 300-year look at some long-term economic trends, which have been very, very good. Then we're going to look at some short-term ones. We're going to look at how government policy affects things. We're going to look at what this current government is doing, and we're going to have a think about what that means for going forward with your portfolio. So starting with the past. If you look at economics over the very, very long term, you can't help but be anything but an optimist, because generally things get better and better. So one way of looking at this is over a 300-year period where the number of people working in agriculture has diminished greatly. So you go back to the time of 1700, 56% of the British workforce worked on the land. They were agricultural workers. They generally were in poverty, and things got pretty tough. So if you remember last year, one of the big recessions we had previously was the Great Frost of the early 1700s. And the food supply was greatly affected around that time, and that meant that people died. So things over the last 300 years have got massively better. So today, only around 2% of the British workforce works in agriculture, and you can see from the slide that the trend has been the same in the US. The US is actually a bigger agricultural economy than the UK, but the number of people working on the land has dropped, and that's brought enormous amounts of improvement in living standards. That's over a 300-year period, and it's pretty obvious. But even if you looked after the last 20, 30 years, the evolution of China as a major economy in the globe has lifted hundreds of millions of people out of poverty. So things generally get a lot better. Another way of looking at these improvements is to look at the number of hours that the average worker works today. Going back to 1870, the number of hours worked was around just 3,000. That would be if you're 48 working weeks in a year. That would mean somebody working around 60 hours a week. Today, the average amount of time worked is around just over 30 hours a week. So there's been a huge improvement in the very, very long term. So if we were looking at long-term trends, you can go back even further than this with some of the excellent stuff that you can get on the Bank of England website these days. You see improvements, and we know things get better. But what happens around that long-term in improving trend is that the government intervenes. And sometimes the government does things for the good, and sometimes the government does things for the bad. So I've got two examples for you over the last 100 years of good government policy and bad government policy, and they both revolve around world wars. These are four gentlemen. They are the leaders of the Allied forces that were victorious in World War I. They are attending the Paris Peace Conference. Lloyd George is on the left, Woodrow Wilson is on the right, and then you've got Vittorio Emanuele Lando and Georges Clemenceau, the leaders of Italy and France, respectively. Now, they are putting the finer detail on what the settlement is going to be for Germany. And they are looking at how much Germany is going to pay in reparation and what it will need to suffer as a result of starting World War I. Keynes is doing work. He's actually at this peace conference. Keynes being probably the best known, the most influential economist of the last 100 years. And Keynes says, look, I think the maximum that Germany can pay is about $10 billion. They've lost all their maritime shipping. They've had to give that over to the Allies. They've lost Alsace-Lorraine. It's been given back to the French. They've lost a significant amount of their industrial capacity. And Keynes thought this was about the maximum they could pay. Unfortunately, around the time, politicians carried great favour by outbidding each other in how much they would force the Germans to pay in reparation for World War I. And some of them didn't want to stop at Keynes' 10 billion. They wanted to go to 30, 40 billion. Now, Keynes wrote an absolute damning book. It's a lovely piece. If you get a chance to read it, it's a very easy read. And he wrote about what the consequences would be for this outcome. He wrote this book in 1919. And he basically said that really all this is going to lead to is an armistice. It will be a temporary halt of hostilities for the next 20 years. He was bang on, because by 1939, World War II has started. Bad economic policy, destroyed European productivity. Continental Europe couldn't get its economies going without a successful Germany, and it was a nasty outcome, as we know. Better economic policy. This is George Marshall on the left. He was the head of the U.S. Army in World War II, and Harry Truman is on his right. These two gentlemen are talked about how they could assist Europe post World War II. Now, you can imagine things were pretty grim post 1945, and in complete contrast to what happened in 1919. Marshall says, our war is not against people or countries or idealism. Our war is against abject poverty. What Marshall said was, we, the Americans, need to support Europe in our own interests, because you can't have a Europe that is suffering so much. People will starve, there'll be great problems, and so they introduced the Marshall Plan. You know, this is a very, very good piece of policy. Modern day, this would have been worth well over 100 billion in terms of various support. But if you look back at economic growth in the UK, you can see the effect of these two bits of policy. 1919 leads to a repeat of World War II, a repeat of hostilities within 20 years of the end, and economic growth during this period is only just around 1.5%. Post-World War II, economic growth is hugely improved at 3.2% average. Good government policy makes a difference. Bad government policy does too. So that's a bit of the past. Where are we today? There's a lot of worry, as I said earlier. There's concern about inflation. There's concern about government debt. There's clearly concern about the pandemic. So are we right to be pessimistic? Is our media correct, warning us about bad things with government debt, problems with the economy, problems with inflation, problem with interest rates, problem with economic growth? Are we right to be pessimistic, or should we be optimistic? I think we should be optimistic. First of all, in terms of the British household, this chart shows you the level of debt for the average British family. In 1995, the average British family is about 23,400 in debt. By 2020, it's up to just over 73,000. But you can see from the chart that the trend grows pretty rapidly late 90s into the 2000s. And then when the global financial crisis comes along, the amount of debt taken on by the average British family begins to slow down. We've become much more debt conscious. We don't take on as much debt as we used to. I think in actual fact, because of the regulations put on the banks from the global financial crisis of 2008, and because of caution around debt, it's much more difficult for youngsters to borrow these days. 100% mortgages are a thing of the past. They were quite easy to get before the global financial crisis. So people have become more debt averse, to the extent that the leverage of the average British family is down tremendously. So you go back to 2008, and the amount of debt held by the British family was around 20% of their assets. Today it's around 15% of their assets. We have, as a nation, personally, we have as individuals been deleveraging for the last 13 years, but that has had an effect on the economy because we spend a lot less. If you put this net household wealth in context, it's up to 11.6 trillion at the end of 2020. If you put this in context, in 1995, it was around just under 3 trillion. There's been a huge increase in net wealth in this country. If we were prepared as wealth holders to give up the growth we've had, on our net wealth in the last 5 years, we would clear off the national debt. And that puts government debt into a completely different context. So we've been going pretty well. And in actual fact, the average British family now has net wealth, net after deducting debt, of around £420,000. The British consumer is in a good position and well able to spend. And if you don't take anything else away from this today, if you want to spend something, if you want to buy something, if you're altruistically motivated, spoil yourself, because when you do that, you do a lot of good for the economy. So government debt, where does this sit? Again, we look back at history. We're going back to the time of Queen Anne again, and this chart shows you the amount of government debt relative to GDP over different periods. Now, you can see that historically, government debt peaks around the time of wars, when government's got to fund hostilities. 1822, government debt to GDP is just under 200%. That's post the Napoleonic Wars. It looks pretty dire then, but the country is about to go through the second phase of the Industrial Revolution, and the Victorian period will bring in, or brought in, immense amounts of wealth for everybody, to the extent that when GDP goes up, the relative debt drops as a proportion of it. And you can see right through to 1913, just before World War I, debt to GDP, government debt to GDP has dropped from just under 200% down to 28%. Huge improvement. Then, of course, up it goes again. World War I costs us a lot of money. World War II costs even more. And by 1946, debt to GDP is just short of 260%. Then we get this nice period of economic growth, partly thanks to the Marshall Plan, partly thanks to Europe being rebuilt because assets have been blown up. We have a nice period of growth, and debt to GDP by 1990 is down to 22%. Long-term average debt to GDP through this period is just under 95%, so at 104% at the end of 2020. Debt to GDP is a little above average, but not massively so compared to major conflicts of the past. Right, inflation. The sharp-eyed amongst you may have noted that James showed inflation in the UK as 4.2% for October. I've got 3.8 because the series I've used is slightly different. James is using the harmonised series, which is the standard applied in Europe. I use this series so I can get back a lot further, and it doesn't matter. The thing is that the trend is slightly up. Is this a problem? You would have heard a lot of people talking recently about inflation being transient. If it's transient, there's nothing to worry about, and the Bank of England is right not to have increased interest rates at their last meeting. If it's not transient, if it's that we're spending too much money and we haven't got the capacity to supply our demand, then the Bank of England would need to increase interest rates. It's very much transient. If you look at this data from the US economy, the blue line is the amount that Americans spend on services, eating out, lawyers for house transactions, and the red line is what they spend on goods, tangible goods. And you can see that the economy, our economy today is well over 70% service-based, and America's is similar. And you can see since the last 20 years, there's been a big trend up in the amount of money spent on services relative to goods. But look on the right-hand side of that chart, and you see that the bounce back in spending on goods is a lot bigger than it is on services. Now, this is dollars, so this is the amount spent on dollars, and goods inflation has been negligible for some years. If you look at the quantity demanded, you see this picture, which really accentuates the issue. The dip on the right-hand side is the pandemic. It's the lockdown. Spending on goods and services dips dramatically in the summer of 2020. But look at the bounce back, the red line in goods. Demand for goods in the US quickly exceeded its pre-pandemic levels. Why? Because when we're all locked down, we can't spend anything on services. But God bless Amazon, they'll deliver anything to your door. So we went online and we started to spend. Goods spending is back to pre-pandemic levels and above. Spending on services is still not in the US back to pre-pandemic levels. So this has had a massive effect on supply chains. You can imagine what, if any of us had been running let's say we were running a car business in the spring of 2020. We were manufacturing cars. The pandemic would have scared the wits out of us because suddenly our demand is dropping off a cliff. So what do? We shut our factories down. And one thing we do as car manufacturers, we say to the chip manufacturers, guys, we don't want your chips at the moment, thank you very much. The modern car has about 1,000 chips in it. We don't want your chips, thank you very much. And the manufacturers say that's no problem. We're seeing a big improvement in the number of demand for our chips for electronic items we'll supply to the phone manufacturers and the makers of iPads and computers. And that change around. The bounce back comes more dramatically than anybody ever expects. And suddenly consumers start buying goods again, and they start ordering cars again. If you've tried to order a new car recently, you'll realise there's a long waiting list to get what you want, mainly because they can't get the chips for it. So this has disrupted the supply chains enormously. Not only have we got a situation where the manufacturers of solid things are flat on their back, they suddenly find that their demand has gone higher than it was pre the pandemic. And of course, things happen badly. And it feeds on itself, this break in the supply chain. It's reflexive because when you find that you can't get the things you want in the time you want them, you tend to pre-order what you may have wanted in 3 months' time. So you increase demand even more, and this will take a while to wind through. But this is the main cause of short-term inflation. It's obvious in the figures. And the supply chain is very flexible. We are very, very good at supplying things efficiently, and it will even out. So the Bank of England was spot on not to increase interest rates, and it would be a tragedy if they try and get interest rates back to more normal levels too quickly until this thing has passed. So the future really depends on demand. And interestingly, if we look at what Keynes said about this, and also what Marx said about demand and about the economy, Keynes always warned that there are times when you enter a liquidity trap, when consumers simply won't spend, you can't get demand going, and it doesn't matter what you do with interest rates. So you could cut interest rates as low as you like. If people are nervous, they will spend the extra money they've got they will not spend the extra money they've got in their pocket, they will save it. And that's certainly been happening in recent years, which is why mortgage equity withdrawal is a thing of the dim and distant past. We tend not to draw down on the equity in our houses these days compared to what it was pre-global financial crisis. But Marx also, who was an advocate or respected free market capitalism, made the point that he thought that in a mature economy, you'd get to a point where there simply wouldn't be a demand for the things the economy could produce because people just generally had everything they wanted. So both of these individuals would have advocated state intervention, perhaps in slightly different ways. But that's what they would say. Are we then in this situation where we've got a demand deficit? Possibly. And perhaps the government has to do more of the heavy lifting. And in actual fact, the government is doing more of the heavy lifting. So this chart shows you government spending as a proportion of GDP. It's the extent that the government is involved in our economy. You can see that at the start of the last century, government involvement in the economy was pretty minimal. The government had armed forces, they provided law and order, and that was more or less the extent of that was the major influence that they had within the economy. 2 world wars changed that, and of course the Attlee government under Labour, it's odd, isn't it, that Churchill lost the post-World War II election, having been so popular and so successful. But it really wasn't Churchill that lost it. It was mainly to do with the Tory party wanting to bring austerity in quite quickly, get debt down, whereas the Labour Party was saying, we want a better life for everybody. We want to introduce the welfare state. We want to introduce pensions. And of course, Attlee got a landslide victory in 1945, and the lesson was learned, and since that point, the government has stayed involved. And it stayed involved to the tune of just under 40% of GDP per annum post-World War II, and that's not going to change very much. In fact, it's been going up. And I said to somebody recently, this is really odd what this government is promising to do with regard to spending and levelling up. And if you'd have put me to sleep at the start of 2007 and woken me up today and shown me this chart and said, who's in power, I would have said Blair had won the last 3 elections. And you can see the movement of looking at that chart again, the dotted line, you can see the movement of government spending to GDP around that line. And generally, a Tory party will reduce government spending to GDP, and a Labour Party will increase it. No longer, though, no longer, because projected spending by the government is going to be above that long-term average, to the extent that this government looks more Labour than perhaps the Labour Party look. In fact, Peter Brooks did a brilliant cartoon in the Times. Let's see if this works. Here we go. He starts with Rishi Sunak, and you can see he's morphing into Gordon Brown. And that's produced by kind permission from the Sunday Times. It's an excellent cartoon. The one thing that's wrong with it is that, in actual fact, this government is probably going to spend more than the Brown would have done as Chancellor of the last Labour government. So things have changed. You know, I jest because I say this might not be. They might not be new Labour, but they look like blue Labour. You can't get a credit card's worth of difference between them now. And that's not a bad thing, because if we're all wealthier and we're not prepared to do the heavy lifting on spending, then there's no reason why the government shouldn't do it. And as you can see from the charts today, we can certainly afford it. So another good thing that perhaps is going to give the economy a boost going forward is the massive changes in the cost of renewable energy. This is probably one of the most optimistic things that we've got going for us at the moment with regard to climate change. And it's the fact that producing electricity from renewable means is now slightly cheaper than producing it through the use of coal. The problem we have, of course, is that we can only produce power from wind when the wind is blowing, or from solar when the sun is shining. With coal, we can burn it 24/7, and it goes on producing. One of the questions which has come up when I've given this talk in the last week or so is, what about nuclear? Nuclear is a very good way of generating power that is clean. It's got consequences if the waste is not dealt with differently, but nuclear is more expensive than these types of renewables that you're looking at on the screen, solar and wind, and more expensive than burning fossil fuels, and that's an issue. So moving towards renewable energy is generally a very, very good thing, in the way that pandemics cause problems not dissimilar to wars. One of the differences in World War II, things got blown up, so assets had to be replaced. That was a boost to post-World War II efficiency. I mean, the rebuilding of Germany was remarkable, what they did post-World War II. You know, thanks also to the help from the Americans and the Marshall Plan, was to actually create an extraordinarily efficient economy. And generally, the second 50 years of the 20th century were a period of unprecedented growth and great increases in wealth. So we're going to get a lot more of these. Some people say they don't like them. You know, I must say that view would look a lot better without these great big white metal windmills. But this doesn't look too good either, and this doesn't look too nice. You know, and I think all of us will want to leave a better world to our children and grandchildren, great-grandchildren. And if we're going to do that, I think the evidence is so compelling these days, we're going to have to do something about the increasing CO2. Particularly because if it goes up to 3 degrees, we will not be here, because this will be underwater. So there are issues. You might be able to go and live in Greenland or move down to Antarctica. There might be some nice properties coming up there and places that were previous snow, but we will not be in London if we don't stop the temperature going up. So I'm going to finish and just summarize what we've been through. We talked about inflation. What is the cause of inflation trending upwards? Firstly, its supply chains have been disrupted due to COVID-19. Consumers have switched from buying services to goods. Goods still form a significant part of James's inflation basket that you saw earlier. That's driving prices up. The UK's got a shortage of low-cost labour due to Brexit. Our seminars this year have been more disrupted due to the problems of the venues getting labour in than they have for any other reason. Trade conflicts will slow the growth of globalisation. Globalisation pushes prices down. If globalisation stutters and halts a little bit, as it will do with the tension between America and China at the moment, then the scope for driving prices down is not as great. Governments are going to spend more. That will be inflationary, but you've got to get demand somewhere if you want growth. That's a good thing. And the globe is going to move to more renewable energy, largely because it's cheap. And if we can solve the storage problem, if batteries become much more effective and affordable, then it's a bright future, because not just from the point of view of the CO2 emissions, also from the point of view, there'll be a lot of activity building new assets. The old ones may not have been bombed, but the old ones will be obsolete for different reasons. So what do? We keep duration short in your portfolios. We don't hold long-dated bonds at the moment. I said that I don't think we're going back to the 1970s, and I certainly don't think that. But there's more of a possibility for an inflation accident at the moment than perhaps there was 10 years ago. And if there is an accident and interest rates shoot up, perhaps what they're more typical long-term, about 4 to 4.25%, then bondholders will get wiped out. They're going to see losses ranging from 30 to 50% of what is meant to be a safe asset. So we are very careful about that. As Jake said, we like to buy our assets at reasonable prices, and we diversify, because you never know what's out there. You know, this time, December 2019, when we're doing this seminar, we never had any idea that we would be locked down the following year. So you never know what's out there. And on a smaller basis with individual companies, you know, anything can happen to but things are looking positive, and the government has given us a very, very clear picture of where they want the economy and the country to go to, and it's this: Peppa Pig world. Brilliant transport, wonderful schools, great discipline, no worry with COVID, but you've got to watch out for swine flu. Thank you very much for listening this morning. Have a great Christmas.
Thanks very much, Gary, and thank you everybody for listening to the presentations today and attending in person or online. It turns out we've got around 200 people and about 20% of those in the room, so it's fantastic having you all with us. We're going to take a quick 2-minute break online. We're going to gather some questions together, get the speakers onto the stage, and then we'll do a 20-minute Q&A panel. Thank you very much. Okay, thank you for your questions. We've had a few, for which we're grateful. I'll start with this one I'm looking at straight away, and this one's for you, James. Global markets are still being influenced by the pandemic. How have they responded to the new Omicron variant?
That's a good question. So the Omicron variant really came into public consciousness, it was 2 weeks ago. Friday the 26th of November, I think it was. Mm-hmm. And on that day, markets fell about 3.5%, which may sound like a lot, but compared to that big 30% drop we saw last year when the first COVID variant came along, it's actually not that much. And since then, the market response has actually been quite muted in comparison. So they took an initial hit 2 weeks ago due to all the uncertainty surrounding that new variant. If there's one thing markets don't like, it's uncertainty. But since then, they've been a bit up and down, but we haven't seen any significant market moves like we saw back in March last year. So it's almost as though markets are sort of becoming accustomed now to COVID developments, so new variants are not causing as much volatility as they did last year. So I wouldn't expect to see anywhere near the levels of high volatility we were seeing back when the virus first broke out last year.
Could you say they're kind of growing a resistance to this?
They're not completely immune, but yeah, I mean, COVID developments are likely to be here for a while, and they're gradually becoming less frightened by them.
Okay, thanks, James. We've got one here that I think is for you as well, so I'll stay and I'll try and work my way down. James, and thank you, Thomas Sunjan, for this question. Where do you stand on the future of cryptocurrency?
Cryptocurrency. So the main problem with cryptocurrency, like I mentioned, is it simply has no real asset sitting behind it. Whereas the more traditional safe haven, such as gold, is very real. You can assign value to it, people do. It's a physical asset. So it will always have value, whereas Bitcoins and other cryptocurrencies still just don't have anything set behind them. So for now, I don't see cryptocurrency becoming the big new thing, which some articles say it may do. Whether it will still be around in 10 years' time, I don't know. It'll be interesting to follow. But no, it's just difficult to accept cryptocurrency as the dominant means of currency at the moment, just because it's very complex and it doesn't have any real assets set behind it.
Yeah, I know as an investment team and strategy, you like to see optimal transparency behind anything that you invest in, but that doesn't mean invisibility.
Exactly.
Kind of transparency and digital currencies, as I understand. They're nothing.
And not to mention it's hugely volatile, which is
Not
which is never a good thing for a risk-managed portfolio.
Any of them FCA regulated?
Not that I'm aware of. No, there's no regulatory bodies sat behind them.
Okay, so we'll be steering clear of that for some time.
Certainly for now, yeah.
Yeah, long-term investing.
Yeah.
Fantastic. Katie, I'd like to move on to you now. We've got a question here. Why have we not opted for a sustainable mandate for the Courtiers funds?
The thing with the term sustainable is that the FCA have acknowledged it's a bit loose. Yes, you have to act ethically in the way that you market your funds, but recently we did a review on sustainable funds in the market, and there's a whole host of them now. There's nearly just under, well, probably we took the figures from October, but now there's probably near 8,000 of them. If you actually drill down to what those funds are invested in, as we did, we went through all the product involvements, and some of those funds marketed as sustainable had up to 43% in controversial companies. So for us, 43% of your fund in animal testing, isn't that sustainable? The way technology is moving and innovating, if we had a sustainable mandate and said, okay, we're not going to invest in any oil, well, you can't change overnight, and those companies need to move forward and adapt. And the demand that's being driven by investors and shareholders now, they're really hammering those companies to make a difference and make a change. So if we shut those off, you're not going to make a difference just by walking away. We actually want to see those companies work and improve, and it is changing. Companies are changing their focus; they are going more renewable. So we want to keep our way open, and also, as James will tell you, diversification is key. You can't just, cut out a whole sector of your portfolio. So we didn't want to close anything off in terms of sustainable, and we didn't want to, as it is at the moment, a wish-washy label that doesn't really define us as we are. Hopefully the next year, the FCA have launched their disclosure guidelines. They're looking to actually find something that aligns with the SFDR legislation. They don't want it to be exactly the same. So hopefully as we move forward, the labelling will become clearer and will fit into a more certain category, but we just don't want to restrict ourselves at the moment.
Yeah, it seems from a kind of uneducated perspective that the future is evolving rapidly. So to leave avenues open makes sense to me in terms of what might be around the corner. Sticking to renewables, and thank you to Tony calling online for this question. Excuse me. I think we can maybe segue across to Jake on this one as well. See what you think. On renewables, Tony says, why do you think we lack the Brunel spirit with respect to tidal and hydrogen to get on and develop these sources which are not dependent on sunshine or prevailing winds?
Yeah, it's Katie, actually, we get about a 20-second glimpse of the questions before we go live. But Katie said a really interesting fact that apparently Brunel was bankrupt by the time he died. And I think that shows, you've got to incrementally go towards stuff that is capital, like
James,
was good use of capital.
Jake, sorry to cut you there, but what is the Brunel spirit?
I imagine it is going full hog, going out and really just building all this resource, whether it's actually been proven to be effective yet or not, and just going home and going for it. But correct me if I'm wrong. But with hydrogen, it's a really interesting race because it came up last year about companies that were putting hydrogen into the gas system to make our gas more sustainable. And actually, in the year, we've actually invested as part of our infrastructure exposure in one of the infrastructure funds called IMPP, and they're actually working with Kiel, doing that research to try to put about 25% of hydrogen into the gas system. Will that work with boilers? Can we clean up immediately 25% of the carbon released from our heating infrastructure and our boilers? So yeah, that is happening behind the scenes. Hydrogen's like is a huge thing going on there. Dad and I are big fans of F1, and a lot of the guys have left there, and they're working on things like synthetic oil, which is bonding hydrogen with other elements that's not carbon, that won't increase our carbon footprint, to make our current cars more sustainable. So these things are going behind the scene, and then once we see one of this things to be effective and an effective way of doing that, I think then that technology will be adopted. So it is happening behind the scenes, but until it has that proof, then it won't be adopted worldwide. But hopefully over the next 5 years we'll see some of these technologies come forward and we'll all be using them.
Does any of your intricate investment analysis processes into these companies, innovative companies, give you any kind of forward insight into any curves that might be being broken? If that makes sense? Anybody
Yeah,
that is
I think
actually
so.
pushing the boundaries to potential new successful?
I think as we've broadened the equity offering, I think it has helped and driven macro ideas. Do you think that's fair? I think with the banks, for example, that IFRS 9 change, when we do hours and hours like reading statements and then looking at the numbers that go into these forecasts, and the banks were at that point were forecasting worst case scenario provisions for loans, and then saying, but we don't expect this to happen. And then when you cross-referenced their numbers for these scenarios with our own of what we saw, it allowed us to hedge off some of the interest rate risk, like I said earlier, in the multi-asset funds. So yeah, absolutely, the micro does feed the macro, and it does give us some insights and tilt the portfolios to things that we do. But our broad strategies, get stuff that's reasonable, keep our duration short, but within that, we tilt the portfolios towards different trends, and we've got to keep the diversification, but it does help, definitely.
Excellent, thank you. Gary, before I move across to you, I'm going to jump back to James. I've got a question from, excuse me, bear with me. It's Sharpe ratios. Andrew Hall, online, thank you for your question. James, when using the Sharpe ratio, what time period do you use? And before you answer that question, I'd like to hop in with a question. What is a Sharpe ratio?
So the Sharpe ratio, the Sharpe ratio, named after William Sharpe, the economist, it's a measure of risk-adjusted return. So you can think of it as how many units of return have you managed to generate given the units of risk that you've taken. So the higher the Sharpe ratio, the more successful the portfolio has been for its given risk level. I think the Sharpe ratios we publish on the fact sheets cover 3 years and 5 years. And I'm pleased to say that the Sharpe ratios of the Courtiers funds are looking good. So if you take the Cautious fund, for example, and compare it with a similar fund from its peer group, let's say the funds were taking the same amount of risk. If our Sharpe ratio is higher, it means we've been able to generate a higher return for that same level of risk as the other fund in the sector. So we always strive to maximise our Sharpe ratios.
Thanks, James. Creeping back that way, Jake. Gary, we'll come to you. Barry Wood online, thank you very much for your question. Jake, we never talk about the processes to eliminate the turkeys. Do we have any I wish we hadn't bought this moments? And what do you do about it if so?
Yeah.
By the way, well done this year, Barry says.
Thank you very much, Barry.
Answer the question.
I do prepare for this question because, with this approach, Jack Bogle, a value investor, says you don't look for a needle in a haystack, you buy the haystack. And I would take that further and say we try to buy the haystack with the most needles in. And then we talk about the stuff that highlights the approach, and to make sure that we keep the portfolio and keep the equity exposure exhibiting the factors that we see, to stay on that blue line on that first chart or the second global chart, to make sure that we are getting the most bang for our buck with our returns. Inevitably, the reason we diversify is you do get some situations where the companies didn't do what you expected to do, or hit with it's maybe not a black swan event, but blindsided with some social change or some dynamic in markets or something they didn't expect. In the global fund this year, a couple of companies that want to prepare for this, that were dragging on our performance, whilst it's been incredibly good, James's charts, they were mainly supply side companies. A Swedish company that was producing kitchens had some supply side issues. It literally could not get the materials to complete its orders, and gave a profit warning based on being able to, because it reduced its revenue. On the UK side, we switched from Stagecoach into Go Ahead Group. At the time, they were both exhibiting the same factors, and we felt that had a broader exposure of transport to take advantage of what Gary was talking about, the spend by the Conservative government to invest in levelling up. A lot of that was focused on bus infrastructure and transport infrastructure, and we wanted to have a more broader exposure to that. Stagecoach with a lot more buses. Go Ahead was a lot broader with offering rail as well, but then they had an accounting error and they lost one of their franchises. So yeah, I wish we'd not bought that. Answer Barry's question. But overall, it's been really, really positive. There's not been many of those stories this year. Markets have been trending up, so it's done very well.
Excellent, thank you. Gary, we've got a question, I'm just hopping around on the internet here, from Tony Calling again. Thanks, Tony, for these questions. So, you mentioned the lucky cat earlier. Well,
very good reference.
It brings you luck in
Very
the form
good
of this
start.
question from Tony, and it hops across to China. So, what's the view about China now and in the next few years? What effect will the emerging trend to question their political motives and clear actions to undermine the economic foundations of the Western economies have on markets in the next 10 years?
I think you're already seeing the effects of a changing approach in China on Western markets. China has definitely been a source of certain volatility. It's obviously the way things have panned out in Hong Kong has been a problem. There are growing concerns about Xi Jinping wanting to unify China, and therefore will the Chinese make a play for Taiwan? And that's a concern. So they increase geopolitical risk with this sort of moving more to away from free market economics and more to state control. I think that what it therefore means is that the world's largest economy, if we do it by purchasing power parity and not just pure dollars, is going to deviate from the trend that it's been on, and that is bound to have some effects. Not all those effects are negative, because if you believe Marx is right with regard capitalism's problem with regarding generating sufficient demand in a mature economy, and you believe Keynes is right that that we get into liquidity traps, and if you believe this is one of those, and if you believe that the developed economies of the world are going to struggle to generate demand, then a spending controlling government is an answer to that demand deficit, and that of course is what China have got. One of the problems, however, is that China's debt to GDP is now greater than the US's, even though, you know, on the best possible measure, their income per head, their productivity per head is about 1/5 of the US. So they've fired their big guns at it in terms of debt, and now they have some issues. And you're beginning to see this kind of stimulation of certain sectors, which the Chinese have been very fond of doing for quite a long time, gets itself into problems, as we've had with Evergrande. So that's their issues. Chinese stock market itself has been punished, as James said. I think it was off 17%, James, last year. So we have not been in Chinese stocks for very good reason, and delighted we weren't there last year. That's also helped our volatility measures, because it's a volatile market to be in. So I think that you're probably going to see the world almost like a new type of Cold War come about, where the blocks occur, and China is obviously very keen to influence the countries around the South Pacific, and but there's always some geopolitical tension there. It's always there, and it changes.
Sure.
Yeah, there's a very interesting. Sorry, you want me to? No, sorry. There's a very interesting note. It's if anybody wants to have a read of it, then to send me an email and I'll send it. But it's a note issued by a Pentagon employee called Lynn Wells, and he issues it in 2001, before 9/11, and it's to do with American defence policy, and they're trying to forecast to the future. What do we do over the next 10 years? And he basically says, if you take any 10-year period in the last 100, you could not have predicted what was going to happen in the next 10. And he starts off by saying, if you're a defence analyst in the most powerful country in the world in 1900, and you're looking at your enemies, you're a Brit concerned about the French. By 1910, the French are your allies. Things change remarkably quickly. And you look at any 10-year block, the last 100 years, and he gives a list of examples. It's a fascinating read. I defy anybody to say that they would have predicted it. So here we are today, 2021, and things will be different in 10 years' time.
It sounds like ESG considerations, really. What's around the corner?
I think it sounds like, I think it's any type of consideration, really. And that's why diversification is important, because you genuinely, however hard you work, you'll never be certain on who the winners and losers are going to be. And that's why buying stocks with a margin of safety, which is what Jake talked about in his presentation, gives you a bit of bomb-proofing, and diversification gives you a lot of bomb-proofing. And you try and put the two together, and then you make... Of course we look at things, of course we take macro, we're always thinking about what's going to happen. But the moment you think you've nailed it, watch out, because you're going to get smashed. The market is beautiful at destroying hubris. That example, 1998, long-term capital management, one of the most successful hedge funds in the world, over 20 PhDs on their list of analysts and 2 Nobel Prize-winning economists. What did it do? Went bust. Brains is no guarantee of success in this business. Thank goodness. Otherwise, we probably wouldn't have done so well. Well, these guys would have done well, but certainly not me.
I know nothing about investment analysis, but I relate to the theories there. Gary, thank you very much. I've just got one, excuse me, one quick question from Barry Wood, but I'm not going to let you answer it. I'd like to drive home to Christmas. Gary's question, how does a hangover affect your judgment? You see why I'm not going to let you answer it. So just before we sign out, we're out of time, but I'd like to think driving home for Christmas and Christmas wish lists. What would you each like on your ideal wish list for 2022?
I guess it would be really nice to see just less volatility in markets. So since the pandemic first broke nearly 2 years ago, market volatility has been above average. And because of that, we've been unable to pursue option strategies because option prices become very high in periods of high volatility. So it would be great for volatility to come down, for us to start engaging with options again, because they're quite a useful means of adding protection to the portfolio. So I'd love to see some lower volatility, and I imagine whether or not we'll get it will probably depend largely on whether there's any more sort of severe variants, but hopefully it will start to come down.
Eyes on the markets,
Yeah.
play them right. Thanks, James. Katie?
We were asked this yesterday. I would probably change it up a little bit because mine yesterday was the same as James. I'd probably, we'd get to a point where the disclosures regarding funds on sustainability are a bit clearer. So rather than everybody, just jumping on the whole sustainable mandate, companies just start to adopt those practices more so that they actually, rather than ESG being a standalone thing, it's something that businesses just realise, actually, if we want to be a strong company, these are the things that we should do so that we're here for a long time, as long as everybody else. So yeah, it'd just be to see how that develops over the coming months, and actually businesses look to think of it as these are the first things we should be doing, rather than let's put some paperwork together to explain why we did these bad things. So yeah, that would probably be
It
mine.
ought not to be a sticker to slap onto the side of
Yeah.
a product or initiative. Great, thank you, Katie. Jake?
To use Barry's language, I want turkeys only for Christmas dinner, and not in the portfolio. But yeah, I have to second James's wish. I think if volatility was to decrease, we could limit the downside and get some of the equity levels up over the period. That would be really good.
Okay, thanks, Jake. Gary?
Yes, I'd wish for the government to stay progressive. I think whether I am a free market liberal, so I believe in free markets, I believe in consumers, I don't think governments do things particularly well, but there's some things they do well, and that's building big infrastructure. Whether you go back to the pyramids or you come forward to the sewage systems in London, and I think we'll get that wish, because I think there's no way that the Conservatives, whether they go into the 2024 election with or without their current leader, are going to, if they want to win the red wall constituencies, so they can win the next election, they'll have to spend. So I would that would be a hope, and I also hope that there's not a knee-jerk reaction and a mistake at the Bank of England. And ironically, the mistake would be a far too rapid response on interest rates. I think they've got that right. I think they understand, but there's always scope for policy mistakes, and that would be a bad one. So more government spending and low interest rates. Let's heat the economy up. Yeah, that's party. Number 10 likes that. So that's
Merry Christmas. Everybody here today, thank you very much for taking your time and coming and joining us in person. And to everybody watching us online, thank you also for tuning in live for the 2021 Client Seminar. We are out of time. Zeros are flashing in front of me. We have a wonderful meal ahead of us if you're here. And for those of you online, sit tight. Oh, and Vamo's just reminded me we've got a competition to announce the winner for. Now, those online, we can't actually see who is online right now, so we will be in touch by email when we select a winner there. But I'd like to invite Vamo, seems as though she's saved the day, for somebody who's going to be receiving a delicious bottle of champagne to come and pick the winner. Huh? Okay. Thorough. Vamo's our events coordinator, by the way. She's all the attention to detail. So thanks, Vamo, keeping us in check. We have a Gordon Saunders in the room. Well done, Gordon. Congratulations. Well done. All the best. Thank you. That's a wrap, ladies and gents. Everyone at home, here, thanks very much. Until next time.